Hi, it's my emotional support dinosaur. I really need him for this video. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. We are here usually to put the fun in fundamentals of accounting, but today, maybe not so fun. But we'll get through it. So what we want to do today is we want to carry on with our merchandise business, and we want to look at sales transactions and how to track those sales transactions for accounting class. Now, this is a companion video to the purchases transactions video where you see the purchase transactions that go along with actually buying our merchandise before we can sell it. So for the purposes of the transactions that we're going to use in this video, we are going to assume that our business is using perpetual inventory. Now, one thing we need to understand for both our sales transactions and our purchases transactions is terms. And we offer terms to our customers, and our vendors offer terms to us. And we need to understand what that means. So if you see terms that say net 30, it means that that bill has to be paid within 30 days and it has to be paid in full within 30 days. If terms are 1% 10 net 30, that tells us that if we pay within 10 days, we can take 1% off our bill. Or if our customers pay us within 10 days, they can take 1% off of our bill. If we don't pay within 10 days, then the whole amount is due within 30 days. So if we don't pay by, if it says 2% 15 and net 45, it means that if we pay our bill or our customer pays us within 15 days, they can take a 2% discount, and net 45 means that the whole of it is due within 45 days if we don't take the discount. And that encourages the company or a customer to pay early to save some money. It helps the company by reducing costs, and it speeds up cash flow. So this is the part where I feel like I need my emotional support dinosaur to get through this. So textbooks have started saying, assume all discounts will be taken. And it has us adjust the cost of purchases or sales transactions based on that assumption. So for example, if you sell something to your customer for $100 and your terms are 2% 10, we are going to assume that your customer is going to take the discount, and we're only going to record the amount that we would be getting after the discount. We'll do some examples so you see that better. So this is not the way that we do things in real life. So in real life, we would enter the full amount of the bill or the full amount of the sale, and then we would take or grant the discount at the time when money changes hands. We wouldn't be assuming that the discount's going to be taken or granted. So this is one of those examples of we need to do things a certain way in accounting class and then forget about them when we get out into the real world, which of course is kind of frustrating to me as a practicing accountant. I would live in the state of despair, but the rent is too high. But let's look at some sales transactions. Now, we've done sales transactions before, and the basic transaction doesn't change. Since this is perpetual inventory, every transaction will have both a sales part and a cost of goods part. And the basic entry is accounts receivable or cash if our customer is paying in cash. And the credit side is going to be sales to increase our revenue account. The second part of that transaction will be on the inventory cost of goods side, and it will be cost of goods sold or cost of merchandise sold, whichever account that company is using. And the credit side will be merchandise inventory. As we're taking it out of our inventory, we're moving it into our expense, our cost of goods. So now we need to add a little detail to our accounts receivable. So accounts receivable is the summary account of all of the customers who owe us money. And the balance in accounts receivable is made up of lots of sub-accounts, one for each of our customers. Now before, we just used accounts receivable in our journal entries, but we're getting much better at accounting now. And we want to add some detail so we know which customer owes us money. In real life, we would be creating invoices for our customers under that customer's name directly. But for the purposes of accounting class, we tack on a name in our journal entry line. So we're going to say accounts receivable dash Funosaur Co. And then our credit side is going to be sales. And then of course we would do our cost of merchandise sold and merchandise inventory piece of that entry as well. Now let's do a sample transaction using Funosaur. Now Funosaur, as you know, is a very popular dinosaur petting zoo. And they sell Terrence stuffies in their gift shop. They also sell prosthetic arms. I'm sorry, was that too dark? Okay. So Funosaur orders from us 100 cases of Terrence stuffies, totaling $1,000. The cost of the merchandise is $400, and our terms are 2% 10, net 30. So if Funosaur pays us within 10 days, they're going to get a 2% discount. So if we ignore that discount for a moment, our entry to record that transaction would be a debit to accounts receivable dash Funosaur for $1,000, sales credit for $1,000, our cost of merchandise sold, a debit for $400, and merchandise inventory, a credit for $400. Then when our customer paid that bill, we would debit cash for $1,000 and we would credit accounts receivable Funosaur for $1,000 to zero out their account. But because our textbook got weird on us, we need to bring those terms into the way that we figure this transaction. So we're going to debit accounts receivable Funosaur not for $1,000 but for $980. And this is our 2% discount on that $1,000. So $1,000 times 2% is $20. We're going to subtract that from our $1,000. And we're going to record our sales of $980. Our cost of merchandise sold, $400. Merchandise inventory, $400. That does not change. Then when Funosaur pays the bill within terms, we're going to get $980 in cash, so we're debiting cash, and we're going to decrease our accounts receivable for Funosaur for $980 to show that they have paid that amount of money. But if our customer didn't make the payment within the discount period, and they paid us the full amount, the $1,000 that they owe us, we've got to do something different with this entry. So we're going to record the $1,000 that we're receiving. We're debiting cash for $1,000. We need to clear out the amount that's owed by Funosaur in our accounts receivable. So we're going to credit that for $980. That is the amount that we recorded for this sale in accounts receivable. But now we've got a difference of $20. So where does that $20 go? Well, now we're going to add that on to our sales account. So we're going to credit sales. So now overall for that sale, we have $1,000 in revenue because we've added on that extra $20 for the discount that they did not take. But let's add a wrinkle to that. Why not? Let's say the customer returns $100 worth of merchandise before they pay their bill. We're going to assume that the merchandise is undamaged and it can go right back out on the shelf. The cost of that merchandise that was returned was $50. So let's look at that entry. So now what we need to do is we need to reduce our sales. So we're going to debit our sales account, our revenue, by $100 to decrease it. And we want to decrease our accounts receivable by that amount for Funosaur because they no longer owe us that amount. And we're going to put this merchandise back into our inventory, so we are debiting merchandise inventory, and the expense related to that sale is now going to be decreased because we have the merchandise back. Oh, but wait, we already booked the discount on the entire amount. Now what do we do, Carolyn? Tell us. Well, we need to decrease our sales, not by $100, but by $98, which is the $100 minus the 2%. And we need to decrease our accounts receivable by only that $98 because that's what we booked originally. The merchandise inventory and cost of merchandise sold stays the same. And then if our customer pays us within terms, everything that they owe us, which is $980 minus $98, They're going to pay us $882, so we will increase our cash by that amount, and we will decrease our accounts receivable for Dinosaur by that amount. But what if they don't pay within terms, you ask? If they do not pay within terms, they're going to owe us the full amount. So it's going to be $1,000 minus the $100 that they returned. So we would be getting $900 in cash, debit to cash. We would be reducing our accounts receivable for Dinosaur by $882, which is the $980 minus the $98, the two discounted amounts for $882. And we now need to increase sales by the amount of the discount that they did not take. So $20 was the discount on the original amount, and $2 was the discount on the amount that they returned. So $20 minus $2 gives us $18 more in sales revenue. And where does that leave us? Crying under our desk, clutching our emotional support dinosaur. That's where it leaves us. But here's the good news. So I've done a sample homework problem for you, and you can download it and go through it step by step and use it as a guide for helping you to understand the accounting homework. And then once we get through accounting classes, we can completely blank out that we ever had this experience. Okay? Is it a deal? So you'll find the link to the spreadsheet in the description for the video, and I think it's going to help to clear things up as you go through your accounting homework with that as your guide. So until next time, stay balanced, my friends.